Good morning, everybody, and welcome to the AF Oliver MarketCast II. I can't really start this without saying a little bit about the shirt. We've got some really important things to talk about and discuss this morning, but I need to talk about the shirt first. It was an extraordinary thing, really, after all the effort that I put into the content last time round. The most comments that I got back were about my choice of attire. So I took that as a challenge and I thought, well, there's a nice little thumbprint to stick on these market casts, and went out to all of you with shall I wear the stars or the stripes, and the vote was resoundingly the stars. Getting on the train to come into the office this morning, I did look like I was riding the favourite in the 2:30 at Kempton Town, but here I am, and I'll give you a choice when we do MarketCast 3 to choose something perhaps a little less loud. I want to kick this off with saying a big thank you to the support team that are working with me this morning, James, Ben and Joan. Great big thank you to you. And also just to say, our audience, our registered audience for this market cast has more than doubled. So I'm delighted to see so many more of you here. In fact, if my dear old mum was still alive, it would have trebled. So, there we go. No, seriously, we've got a great audience this morning, but we've got an awful lot to get through. We are not going to do the audience poll this time round, just because we're trying to squeeze so much into 30 minutes. Get all this insight to you and let you get about your day. But you will be able to post questions online. You'll be able to post questions via Zoom. And if we can't get to those through the broadcast while the broadcast is running, then what we'll do is we'll tackle those questions by email. Last thing, just before I start and get into this proper, I've had quite a few people direct message me on LinkedIn asking about their own personal situation with houses and property transactions and so on. I think it's really important to say that this market cast is very much an industry-wide averaged market cast. Generally, when I do these sorts of presentations in regional businesses and developers around the country, I can tune it into the local markets where those developments are. It's much more difficult when you're actually doing a national or reflecting a national picture for people to actually take good guidance on that and what they might do with their own personal circumstances. I've always been a great believer that if you want to buy a house because that's somewhere you want to live, forget what the market's doing, just go and do that. I know a number of people who have actually sold properties right at the beginning of 2021, waiting for the market to fall, and guess what? They're still waiting. So yeah, just a small point. Okay, all right. The other thing, of course, the other point to make is that when you are advising somebody on whether buying property is a wise move at any given time, is the massive difference between local markets and property types. You know, quite honestly, the difference between buying a detached house on the outskirts of, say, Cardiff and buying a two-bedroom flat in Bermondsey is probably more than 10%. So it's an important point to make. Okay. There are still reasons to be cheerful. I've called this webcast to a market holding its breath because I genuinely believe that's what it is. It's a market holding its breath. But there are reasons to be cheerful. The nationwide index still charges on. Who would have believed that the March nationwide was going to reach 14.3%? That's its highest since 2003, 2004. I'm sure there'll be a lot of you that will remember that market particularly well. And that was a market that stretched over some 18 months in the build-up to the big crash, of course. But nationwide still charges on. Demand, well, I love the Nationwide's own terminology. Robert Gardner there saying, demand stays robust. My word, it certainly does stay robust. Good properties, desirable properties that come onto the market are still selling in days rather than weeks or months. So there is no question that that demand is still there. We'll talk about the stats in terms of volumes in a moment or two when we go through the presentation proper. And of course, supply is still limited. Here's the demand, here's the supply. Well, we all know what that does to the market and underpins it. If you look at mortgage approvals, which is a great canary statistic, if you want to look forward at the market 3 months forward, look at the mortgage approvals now, and they're still running above pre-COVID levels. More detail on that to come. And we've got a really strong labour market. Is there anyone watching this MarketCast that isn't struggling to find people at the moment? Pretty much across all industries and all sectors, the labour market is really strong, and that of course underpins the market. Back in the day, I'm going to be talking about consumer confidence, and we'll be running through the current consumer confidence barometer later. But a few years ago, we used to include the employment market statistics in that because it does have such a big bearing on where the housing market's going next. There are, however, causes for concern, and I think you'd be surprised if I didn't cover those too. We all obviously realise the dreadful war in Ukraine rumbles on, and that's a dreadful thing, and that causes geopolitical concerns everywhere. Nobody quite knows what the implications are for the economies, the Western economies, the wider world from that. So that's more uncertainty that feeds into consumer confidence. Inflation rises to 7%. When you actually look at the numbers, 7% is the highest the CPI has been since this new measure was introduced back in 1997, and it's gone up from 6.2%. And economists now are saying that it is not out of the realms of possibility that we'll see inflation hit double digits before this year is out, and that's enormous. And that actually, it's really worth bearing in mind when we look at the UK residential property market and we talk about figures like 14% inflation and how outrageous that is. When you account for the fact that there is 7% inflation going on in the economy, that sort of brings that down, its rise down to 7% above the general economy, and makes it slightly more bearable. The consumer confidence barometer we'll talk about, but my word, that is in a bad way. For an article that I had published in House Builder earlier this month, I went back to my old housing reports back from 2008-9, and I dug out the consumer confidence barometer from back then, and it's quite extraordinary how similar the shapes of those charts are. I am not suggesting for one moment that we are going to see a crash the sort of crash that we experienced back then. The financial institutions caving in was probably a once in a lifetime, let's hope a once in a lifetime event, and I don't see anything like that on the horizon right now. Interest rates. Well, we can see, we'll talk about interest rates in more detail later, but interest rates are undoubtedly on an upward trajectory. We all know that they are the key weapon that the government uses to tackle inflation. So there is only one direction in which they're going to travel, and we all know what effect that has on the market too. Finally, the price to earnings ratio, which in horror, when I watched back MarketCast I, I talked about as a percentage rather than a factor. Do excuse me that one obviously deliberate slip, but that is now approaching 7 times. So that really is a number that we need to be aware of, particularly as we see interest rates rising. So that's a really important number. Let's get into the data then, and the data proper. Always kick off with the Nationwide and the Halifax, just showing you the headlines from these. You'll all be aware of it because these are the two key measures that attract most of the media interest. And as you can see here, here's the Halifax weighing in with 14.3% inflation for the year to the end of March, going up from 12.6, and yet what is extraordinary, and this doesn't just apply to the Nationwide, it applies to the Halifax II, is that they come out with these record numbers, and buried in the editorial down here, you'll find somebody saying, yeah, but we believe it's all going to slow down in a minute. So they all talk about all the conditions that actually have caused this price surge, and it is worth using the word surge, but they all warn, they all say, yeah, but hang on, there are headwinds and there are worse things to happen around the corner. But it's the highest rate of inflation that we've seen since 2003, 2004, and here's Halifax coming in with an annual change of 11%, very much along the same lines. They mirror the Nationwide, but the Halifax are just the same. They're suggesting there's going to be a slowdown later this year. I think that being realistic. Honestly, all of the people that I talk to, right across the industry, pundits, we all believe there is going to be a slowdown. I think one of the real questions I want to address in the next 20 minutes, because I can't believe 10 have already gone, thanks Joan, is the speed of that slowdown and the severity of that slowdown. That's what really matters to you, the audience watching this webcast, and that's actually what I want to try and address before we're finished this morning. That's what makes this particular webcast a really important one, and I think those over the next 2 or 3 months where we actually keep our fingers on the pulse of these key indicators. Let's have a quick look at the nationwide regional. I didn't do this in webcast 1 because the numbers were so old. Back in the day, Nationwide used to publish these numbers on a monthly basis. Now they only publish them on a quarterly basis, which means that we're actually, as at last month, we were looking at numbers that were virtually 3 months old. These are now much more up to date. So these are the numbers as at the end of March. And this is the point that I was making earlier on when I talked about the difference in rates of inflation across the country. Here's Wales over here. Look at this. Wales sat there at 15.3% inflation annual change this quarter. And here's London sitting down here at the bottom with 7.4%. Still good, strong rates of inflation, but the difference between the two is absolutely massive. And if you add into that the difference in inflation between property types, I'm going to go into a little more detail on that in a minute, but if you actually add in that difference too, these differences are enormous. They are double-digit differences, and that means when we're actually planning what we're doing across a portfolio of regions or developments across the UK, it's really important to drill down into the local markets and to look at what the mix is on each individual development before we develop a strategy, a development specific strategy. Really important to do, but you can see where we are and you can see where we're running and how the regions are performing generally. If we go to the 3 month on 3 month number, one of my favorite measures, those of you who have seen me present in the past, you'll know how much importance I put upon this, because that 3 month measurement tends to iron out most of the peaks and troughs and glitches. Nothing can iron out the COVID troughs, obviously, so we actually take those off to one side as a unique event. And you'll remember perhaps from MarketCast 1, I actually painted a trend line on there because, as you would obviously expect, I left producing this presentation right to the last minute. I actually didn't have time to redraw this beautifully painted trend line. So I've just had to shift it and move it a bit up. It still works, and I still believe it works, even though we've seen this real shift up, this incredible surge that there was from January and February, that as the new year came in, an unexpected surge, I've got to say. However, I still believe that trend applies. And I think when we look at these numbers in our next market cast, that will demonstrate it. And now, of course, I'm on record for having said that and predicted it. So a canary slide. The really important slides in this deck I've called canary slides because it's one thing looking at the nationwide and the Halifax data, but anybody can do that. It's all freely available online. What's much more important is to be looking at data that points where the market's headed next. So from that point of view, this one's really important. It's the mortgage approvals. And I've been really lazy here because what I've actually done is I've used Nationwide's chart from last month and instead of sort of redrawing it, I've put this month's here in this rondel. I hope you'll excuse me that little bit of laziness there. But here you can see this here. February mortgage approvals now are just about 71,000. And bearing in mind that mortgage approvals are about 2/3 of the market generally, don't sort of hold me to that number exactly, but that's generally where they stand. That's about 18% down on last year, but we know last year was an incredible year. It is still well above the pre-COVID levels, and this is why I kept this chart, because I thought it was such a good one here. And you can see that Nationwide painted on here the 5-year average, 2014 right up to pre-COVID, and that average was sitting for the month at about 66,000. So we are still well above that average number. That market is still strong. That's really important. I still think we are going to end up the year with about 1.3 million transactions, over 40,000 in the UK. But this is important because if that's where the mortgage approvals are sitting, that's a really good and very, very reliable short-term measure. You know, there is no dodging that's where we are with these approvals. We can be pretty certain where the market's going to be over the next 3 months. I've started including this for webcast 1, first time that I put it back in the deck, but this is now staying here for the time being because that number is an alarming number. And you can see that the last time, you can see it's the highest it's been since this chart has actually been, since Nationwide have actually been producing this chart. The last time we saw anything like it here was way back at the height of the crisis, or just prior to the crisis in 2008, 2009. And here we stand. Now, okay, while fixed rate mortgages are available at 2% and even lower, then that's not quite such a big factor. But as interest rates rise, this is really important, and this will have an effect. There's no question about that. So we will keep an eye on this. I've also included at the back end of this deck Zoopla chart that actually shows how those price earning ratios vary by region as well. Great little chart this. If you do read the Nationwide on a monthly basis, their report on a monthly basis, they always bury something good in there. There's always some really interesting and insightful data in there that we can actually use to advise what we're doing. And I thought this was great. So these are the price gaps between the different property types and how they have changed over the last 5 years. So starting at 0 in 2017, you can see here, this is what the price gap was between flats and terraced, 0. And between flats then and semi, and flats then and detached. Look what's happened over the last 5 years, and look how it's accelerated during this massive change in lifestyle when lockdown came along, when people wanted to be working from home, when they wanted a patch of garden, when they needed a study. So that whole lifestyle change has accelerated the difference. Look where we've gone here. So this is the difference between average price as calculated on the Nationwide algorithm in between 2017, 0 between flats and terrace, up to here. So just have a look where this price difference is here now, flats to terrace. And then actually have a look at where we go terrace to semi, and then have a look where we go flats to terrace semi to detached property. If ever you wanted an absolute demonstration on how the change in lifestyle has affected the property market, it's sat there, I was going to say in black and white. It's actually in colour, modern technology for you. But that's a really good demonstration of what's going on. The gap between flats and houses has doubled from 12k to 25k, and that's in the last 2 years alone. That's tough on first-time buyers, and that should certainly advise the industry when they're thinking about mix and planning new developments. We've got to talk about interest rates. I'm starting to get worried about time now, but we have got to talk about interest rates. It's really important. I'm not going to dwell on it because you'll all be aware of this, but just have a little look and see how interest rates are moving here. So this chart here on the left-hand side is basically a 2-year fixed mortgage rate, and the different colours are the different loans to value. So you can see that up here we've got a 95% loan to value at the top, and down at the bottom you've got a 60% loan to value, and then all points in between. These are the very latest, as of yesterday, Bank of England numbers, and you can see where that trajectory is moving. This is important for us, it's important for the industry. And then if we look at, this is a 75% loan to value mortgage, and then the different colours on the chart here are the different length of fixed term. So you can see here, here's the 10-year money at the top here. And interestingly, when we did MarketCast I was making the point that the 10-year money was falling despite the fact that the 2, 3 and 5-year money was actually increasing. But what is really interesting here is to see the uptick in the 10-year money. These guys, they know what they're talking about. You know, the financial people on the money markets really know what they're talking about. And that uptick in the 10-year money is a really good guide to where we're heading. I'm told we're 20 minutes gone now. I can't believe that that's happened. I'm going to really accelerate for the last 10 minutes, and we'll get to the most important part of this presentation. These are the current UK volumes. Guess when the new data's coming out for the UK volume. So this just shows me February numbers, which seems like a lifetime ago now. The new numbers are due out at 9:30 this morning. Would you believe it? But here's the thing. There's a couple of pieces of data. This one, and more importantly, the Consumer Confidence Barometer, are both due out within, well, this morning, the Confidence Barometer tomorrow, a couple of other bits and pieces too. All of this data that's just about to be updated, I will put out there on LinkedIn. On a LinkedIn post, you can see how we're moving, but you can see where volumes are going. We've talked about volumes already. Okay, I want to devote a couple of minutes to this slide. This is the big canary slide in the deck. This is the Consumer Confidence Barometer. It's really, really important. I mentioned earlier when we were doing the introduction that the last time I saw a shape on the chart that looked like this was back in 2006, 2007. If you have a little look at House Builder this month, Ben Rosgrove, you just want to put my check in the post for that promotion, that's fine. But take a look at the article in House Builder this month, and I've actually put in that article that old chart, the old 2006, 7, 8 chart, and you'll see the remarkable similarities on the shape. It's a completely different economic background right now to how it was then, and I absolutely do not expect the market to perform in the same way. But what I do know from experience of following this data for over 20 years is that the market is going to follow this track. I know it is. I absolutely know it is. So despite the unexpected surge that we've seen in the market in the first quarter, this white hot first quarter, I know it's going to slow down. And so what I'm trying to do is piece together from all of these various pieces of data just when it's going to slow down and by how much. But just take a look at this. These falls, I haven't got time to go through all of these lines in absolute detail, but this blue line is the public confidence in the general economic situation. So when GfK asked 2,000 people in the month how they feel the economy is going to perform over the next 12 months, all those that say great is a plus number. It would come in above this red line. All those that say it's going to be worse than last year, it's a negative number and it's going to come in below this red line. And then the balance is on this chart. Well, you can see you'd need to go back to the spring of 2021 if you wanted to find the last time that was in positive, and that has come crashing down ever since. The new numbers on this are due out tomorrow, and I'm anticipating that will show a continued downward trajectory. The red line on there, by the way, is the overall consumer confidence index. The green line here is the appetite to make a major purchase, a house, a car or a kitchen, and you can see where that's headed to, into strong negative territory. And then this mauve line here, which sort of defies gravity, that's when they say to people, how do you think your own personal finances are going to go over the next 12 months? Your own household, are you going to do better or worse? And normally, whatever happens, Brexit, anything, that stays pretty much steady along that red line, and you can see where that's headed due south. And I don't know whether any of you, much like me, have got those energy meters at home. And I look at mine now and at the end of every day and see that it's more than double where it was back in March. And there will be a lot of people looking at those energy meters and feeling the same thing. And I think once we actually feed that through into those confidence numbers, that's going to look a lot worse. Believe you me, if experience is anything to go by, the market is going to follow that. It's just picking out the rate of that decline. Here's the latest RICS survey. This is the March survey. 482 branches here, 273 responses. So I always caveat this with just being aware of that sample size. But it's normally a really good indicator of how the agents are feeling out there, and most importantly, how the surveyors are feeling out there. These are the guys that are valuing properties. You know, if you take a whole bunch of surveyors and they all say prices are going to fall over the next 12 months, guess what prices do? You know, it's a sort of QED moment, and you can see here that the agents are saying that the market is staying resilient, but we know that there are headwinds out there, and it's just the same as Nationwide are saying and Halifax are saying that although things are really good right now, there are headwinds ahead of us. So the canary slides that we've got from the RICS survey as we head into the last 5 minutes of this webcast. Newly agreed sales over the past month, and you can see that's actually starting to normalise. Most regions here said last month was better than the month before. There is a little bit of negativity there coming across in the East and West Midlands here. I feel like somebody doing the weather forecast now. And there's a depression coming in from the east, but you can see there where there is a little bit of negativity in the East and West Midlands. And new instructions, this is the very, very good news, really important news. For the first month in as many months as I can remember, there has been a slight increase in properties coming onto the market. That's really important for normalising the market, reducing this crazy, unsustainable level of house price inflation. And I think that if we get a really good flood of properties onto the market, that will cushion the way that this market actually comes off of this incredible peak that we're at the moment. Again, a little bit of negativity in East and West Midlands, but it's amazing. I get the feeling of the weather forecaster in Groundhog Day, but the East and West Midlands here. But you can see generally across the UK, and if you look at the national picture, there was an uptick in the number of new instructions coming onto the market. That can only be good news. These are new buyer inquiries. You know, I'm not going to dwell on this, don't have time, but you can see how much that is in positive. And in terms of regional prices, well, we all know, you don't need to be a genius to see that those prices are still up on the month before. And we've seen all the data. Look at this. There's a tiny little tail on that number. This is the average stock per surveyor in the UK. This is a really important number, that you know, the availability of property that makes the market tick. And you can see that just ticked upwards in that last month. So that's all good. Still well down below the long run average, but I think that is a shifting picture. So that's great. The agents and the surveyors believe both in 12 months that they'll see prices rising, and in 3 months they'll see prices rising, although not quite such a big margin there. And in regional price expectations, well, it's this East Midlands guy. You know, whether it's just the same guy, if it is, somebody needs to go up there and help. Make sure that they don't go above the first floor with open windows. But you can see there that generally, regionally, the agents believe that prices are on the rise. I'm not going to dwell on the Rightmove index purely because it's the March one still. Don't have the latest Rightmove numbers, but I'll put a slide update out when that happens, because we're literally coming into the last couple of minutes now. So I'm going to race through those. The Zoopla index, by contrast, does warrant a bit further discussion. A couple of reasons. Number one, these are the sort of latest Zoopla numbers. You can see there that their house price inflation, and they have a unique way of collecting that data, is currently running at around 8.1%. Take off 7% general inflation, and that actually now starts to look somewhere approaching normal. But this is really important here. The demand for homes in the 4 weeks to the 20th of March versus the 5-year average is up 65%. That's a really good indication as to why we've seen this surge in the early part of the year. And if you look through all the regions in the business, Aberdeen aside, which actually had a fall in the month to February, you can see there that Aberdeen was a slight fall. But aside from there, you can see we've got Liverpool sitting at the top in terms of city indexes at 10.3%. right the way down here to the Scottish market, Edinburgh and Aberdeen. What is interesting as we enter the last minute is that the Scottish market, according to the Nationwide, had 12% inflation in March, which is the highest it's been for, I think, since 2007. Have a look at this slide here. If there's not enough time for you to look at it properly now, let me know by direct message and I'll send it to you. But this is the Zoopla price to earnings ratio by region, and you can see, look at this. Here's London here sitting right up there, approaching double digits ratio. That's a really very, very high number, with the most affordable property you can see here being in Scotland. Well worth a more detailed look at that chart. This is another great Zoopla chart from their numbers this month. This is their buyer demand chart. It is a little bit like stating the obvious, I guess, but I think it's really, really useful as a snapshot to show the demand by region and to actually see where that's moving and identify those trends as well. I thought that was a really good chart and actually deserves a little more attention. This is all available, by the way. This is on the Zoopla website, and you can pick this up on the Zoopla Advantage. There is some great data on there. Well done, Gronny Gilmore. Some takeouts as we approach the last few seconds. The volumes are definitely normalising. I don't think there's any doubt about that. They're still above pre-COVID levels. We're going to end up, I'm convinced we're going to end up around 1.3 million for the year. So significantly higher than in the 5 years prior to COVID, but nothing like the levels that we saw last year. The first quarter surge has caught us all a little bit on the hop. But I see that normalising, and I think that we'll see that normalisation continue as we go through the year. We've still got significant demand. If you put anything decent on the market right now, it's gone. 9 times out of 10, the property's actually already sold before it gets on the portals. It's extraordinary how that demand is still there and still so strong. So we've got robust demand. Although we've got that little uptick in agent stock, which I think is so important and such good news, it is still limited availability. So the words of the Nationwide there, robust demand and limited stock. We have an extraordinary employment market. Trying to find people at the moment is really tough, and we all know what that does to the economy, so that's important too. The rate of inflation, well, that's house price inflation there, by the way, not general inflation. The rate of house price inflation will fall, but I am convinced that in 2022 it will not move into negative. We're not looking at cliff edge. We are looking at normalisation. I'm sticking by my January prediction that by the end of the year, the inflation will be down to 6%. But you do need to bear in mind what that means, because if we're running from 14% now, well, between 8 and 14% now, depending on whose index you actually follow, and we're going to take that down to 6% at the end of the year, then that's quite a sharp standing on the brakes. If you imagine you're going along the motorway at 70 miles an hour, and in the next 200 yards, you want to be doing 30 miles an hour, the passengers in your car are going to feel those brakes coming on. The fact that you're still moving forward has nothing to do with it. That brake effect will come through in what we're doing. And particularly when you're looking at developments and you're pricing for sale for August, September, October, November, it's really important just to keep that in mind. And as you can see here, I've sort of nailed my colours to the mast. I think it's going to be August. I think it's going to be August, September. There is a 3-month delay generally in the times that it's taking for transactions to work their way through the system. And so I think that with the activity that's going on now, that will sustain this market through the early parts of the summer, through May, June and July. I think that we'll see this normalisation happening in August and September. And I think that while we're staying positive inflation, that slowdown, well, we'll all feel the brakes go on. Okay, there it is, a slight overrun. So my apologies for that. We've tried to squeeze a huge amount into 30 very brief minutes. I wish you could sense how fast those 30 minutes goes when I start doing this presentation. We'll give you the date for the next MarketCast as soon as we possibly can. We'll send that date through in the next few days. I want to try and plot the date so that I take best advantage of when the data is actually published and released. So it's at its very freshest and most useful for you. And in the meantime, I'll leave you with just a thought. There will be a lot of people watching this webcast that will remember dear old Bill Bannister, so sadly departed from us now. But I worked for Bill he was Wilson Connolly and he was Tay Holmes, and so he was a brilliant salesperson in the house building industry. And Bill had this thing where every single year Bill said there's going to be a property crash. And when one lunchtime over a few glasses of claret, I said to him, Bill, you say this every year that the market's going to crash? He said, yeah, but here's the thing, Matt. He said, one year, I'll be right. And on that note, thanks ever so much for spending half an hour with me this morning. I'll leave you to go about your day, and I'll see you when we come back for MarketCast 3.